Okay? So tax deduction, we're reducing the amount of taxable income. Now, the favorite that everybody wants to use interchangeably with it, tax credit, I would say, just for the sake of not making a universal statement, that a tax credit is going to be 9 times out of 10 better than a tax deduction. And here's why.
Welcome to the Tax Relief with Timalyn Bowens podcast. Are you behind on taxes? Is the IRS threatening you or your business? Are you overwhelmed and confused about how to resolve your tax issues? Let's join Timalyn as she explains your options and how she may be able to help. Timalyn Bowens is America's favorite EA.
Hey family, here we are for episode 25, and it is hard for me to believe we are almost 1 full year into the podcast. Thank you for tuning in every other week and making what I love to do enjoyable. Now, if you have been listening along for the past year, you know that I am passionate about filling the tax literacy gap. So every now and then, we focus on preventative care instead of the actual tax relief. Because let's be real, if we don't work on the preventative care, you're going to be right back in the same situation. So as I was looking at the data from the different podcast episodes, I was looking at the YouTube channel. Back in January, I did a series of W-4 videos. So how to fill out a W-4 if you were single, married, filing jointly, the whole shebang is there. Even if you're retired, filling out a W-4P. And as of today, there are about 14,200 views on those videos. So one, thank you for consuming the content that I'm putting out, engaging, asking questions. But from that data, I also learned that I want to go back to the basics. I want to use this platform to be able to educate you. Again, not so you understand taxes as well as me, not so you fall in love with them, but if that is you, maybe I need to hire you. So maybe you need to go to the contact page. But in all seriousness, I want you each spring to feel comfortable with what you're signing on your tax return. And that's the whole purpose of why I write, why I do this podcast, so you understand your actual tax situation. So in today's episode, we're going to talk about the tax basics. This is Taxes 101. This episode is one that you need to share with your teenager that just got their first job, your friend that just got married. Make sure that your college students have it. And even if your parent is still filing tax returns, share it with them. Because all across the board, I've seen tax misunderstandings. Unfortunately, I've heard other tax professionals use these terms that we're going to go over incorrectly. And how can you prepare for something each spring if you don't understand it, right? So we're going to talk about the progressive pay as you go system that we have here in the U.S., and we're also going to cover 5 basic tax terms. Now, I do have a blog post with 15 tax terms every taxpayer needs to know. It's also on YouTube. So I'm not going to go too far into detail with these 5 basic terms. If you want to learn more about them, you can check out the blog post at americasfavoriteea.com and also the YouTube channel. Just as a friendly reminder, I told you all last episode in 24, the nuggets are in the notes. Jim does a fantastic job of making sure that you have backlinks to all of the resources that I mentioned. So if you're interested in checking out that blog post, it will be linked in the notes. So again, very basic. Let's look at this first tax term, tax return. I hear so many taxpayers refer to their tax refund as their tax return, which actually the tax return is the form that you file your taxes on. So if you're an individual taxpayer, which most all of us are, your tax return is going to be the US 1040. If you have a business, let's say you're a partnership, you're going to file a 1065. Those forms are the actual tax return, which differs from a tax refund. A tax refund is what you get back after filing your taxes if you have overpaid. All right, so tax return is the form that we're filing and reporting our income and deductions and credits on. Next, let's look at taxable income. This confuses a lot of people. They think if they make a certain amount of money, that right out of the gate, that's what they're getting taxed on. And actually, the IRS does give you a little bit of cushion. Each year, you have the standard deduction. When we apply the standard deduction, that is going to subtract from your taxable income. And I am going to talk about deductions right after this. So if you're like, I don't really understand, just hang on a minute. But let's look at, let's say, a married couple, okay? For the 2023 tax year, they automatically are going to get a deduction, if they file together, of $27,700. So let's say the same married couple has income, a combined income with their W-2 jobs of $100,000. They are not being taxed on the $100,000, folks, okay? The IRS is going to allow them to apply the standard deduction first. So we're subtracting that $27,700, which, be patient with me, they're going to get taxed on $82,300 instead of the $100,000. So when we're looking at tax brackets later, keep that in mind. What you're making gross on your paycheck actually isn't what you're getting taxed on. And that's why you have to fill out the W-4 properly, because it makes adjustments for what your actual taxable income will be. Shameless plug. If you don't know how to fill out the W-4 properly, you do need to check out the YouTube channel, and I'll walk you through with different examples of how to fill out the W-4 based on whether you are single, head of household, or married filing jointly, even if you have multiple jobs. The next term we're going to look at is tax deduction. I see this used interchangeably with tax credit all the time, and it's wrong. Okay, it's wrong. A tax deduction is going to reduce taxable income, just like in the example I gave you earlier. You can apply the tax or the standard deduction, and it's going to reduce how much you're taxed on. Now, we have things like itemized deductions. So for people who own houses, they can deduct the mortgage interest that they pay. They can also deduct charitable contributions. One of the misunderstandings that I see every year around this concept is that a person thinks that if they give $10,000 to a charity, they're going to get $10,000 back on their taxes. And that's not the way it works. So if we go back to our example of the married couple who makes $100,000, let's just say initially that is their taxable income, okay? If they itemize and they give an additional $10,000 to a charity, they're not going to get $10,000 back on their taxes. The amount that they're getting taxed on is going to go down by $10,000. So instead of getting taxed on $100,000, now they're going to get taxed on $90,000. Okay? So tax deduction, we're reducing the amount of taxable income. Now, the favorite that everybody wants to use interchangeably with it, tax credit, I would say, just for the sake of not making a universal statement, that a tax credit is going to be 9 times out of 10 better than a tax deduction. And here's why. A tax credit is like a credit to your account. That credit is going to reduce your actual liability dollar for dollar. So let's look at somebody that owes the IRS $2,000, okay? If they have a child under the age of 17, they can claim, if they meet other criteria, the child tax credit. The child tax credit for the 2023 tax year is $2,000. So when applying that credit, they are going to be able to knock out each dollar of that liability. Okay? So let's say they have a child that is let's say a senior in high school, over the age of 16. Instead of that $2,000, now they're eligible for what's called the other dependent credit. That credit is only $500. So if we have a tax liability, or they owe the IRS $2,000, when applying that credit, the amount owed is now going to go down to $1,500, because that tax credit, again, is going to be applied dollar for dollar against the tax liability. So you may be listening, thinking, you know what, but I never owe the IRS. I don't have a tax liability. And wrong again. Unless you make less than the standard deduction, you have a tax liability. But here's the thing. You haven't been educated to know that just because you don't owe the IRS in the spring doesn't mean you don't have a tax liability. So for my people that are single or married filing separately, if you made over $13,850, you have a tax liability. For my people that'll be filing as head of household in 2023, if you make over $20,800, ta-da, you have a tax liability. What happens is throughout the year, we have withholding that comes from our different sources of income. So if you work a W-2 job, your employer withholds money each check, and then they make those payments to the IRS for you, because Uncle Sam wants your money as you earn it, okay? For my people that are business owners, you should be, emphasis on should, because you may not be doing it, you should be making quarterly estimated tax payments. And we talked about that a few episodes ago, how to calculate that and when those need to be made. Because again, Uncle Sam wants your money as you are earning it. So when you get ready to prepare your taxes, towards the top of page 2, you do actually see your tax liability. And let me rephrase, because remember, I'm looking at these forms all the time. So sometimes the assumption that you know what I'm talking about is there. So let me go back. If we look at the 1040, page 2 of the 1040, towards the top of that, you'll see the tax liability. If you don't owe at the end of the year, that's awesome. But when we look at the tax liability, we first apply tax credits to it. So if you're a taxpayer that has children, we are going to apply that child tax credit to the liability first. Then if you have any other types of credits, so maybe you have the dependent care credit, maybe you got an electric vehicle, okay, and you got that $7,500 credit. We're going to apply that to the liability first. Then we look at the withholding from your employer or your pension plan or your quarterly estimated tax payments. Once those are applied, if you get a refund, that simply means you overpaid. So for somebody like me, a business owner, I don't want a refund. You guys know what I could have done with $1,500 throughout the year. If you're a business owner, I want you to take that into consideration. Do you want a refund from the IRS? So you want to overpay them, not get any interest on it? Or would you rather break even so that you can use that $1,500 to invest into your business, and you could be investing into more efficiencies? You could be investing into more marketing so you can make more money. Just take that into consideration, okay? Last but not least, I'm going to hit this quick, because I do mention it in other episodes, but I realize maybe you don't actually understand what I'm referring to. We have a pay-as-you-go system, right? Uncle Sam wants the money when you earn it, but it is a progressive pay-as-you-go system. And what that means is if you're in the 22% tax bracket, all of your money is not taxed at 22%. What do I mean? let's go back to that couple that, they're married filing jointly and their W-2s combined is $100,000. Now, if we just look at the $100,000 and we look at the tax brackets, we see that income over $89,450, but under $190,750 is in the 22% tax bracket, right? But remember what I just told you earlier in this episode. Before looking at taxable income, we have to make sure that we've already applied all deductions. So for them, they're going to have the standard deduction for 2023. That is $27,700. See, I got real mathy here. That's why I tell you guys to get a pen and paper. So when we look at their actual taxable income, the taxable income is going to be the $82,300. So if we're looking at the tax rates and schedules, we see that they're actually in the 12% tax bracket, not 22. But that doesn't mean that the full amount of their taxable income is going to be at 12%. See, what the IRS does is their first $22,000 is going to be at 10%. And then any amount over that, that's under $89,450, is going to be at 12%. So let's look at it this way. Every taxpayer is going to pay 10% on part of their income. Even if we have somebody making $300,000, their first $22,000 is going to be at 10%. And then we know their income between $22,000 and $89,450. So essentially about 70. That is not 70. So you guys, let me make a confession here. I'm just getting back into the gym. I'm excited to be here with you all. But sometimes I'll blame it on 30s. My math in my head's not always mathing. So if I have a little boo-boo, slide me a DM, let me know so I can make the correction. But I'm healthy. The brain just doesn't always work like it used to. Sometimes I need that calculator here. But what I was saying, we have the first $22,000 at 10%. Then the amount that's from $89,450 and then subtract the $22,000 is going to be at 12. So everybody is paying 10, 12, 22 if their income is up. So somebody in the 35% tax bracket is not getting hit with 35% on all of their income. That is the long story short. Now, I know that for some of you, you may be like, yeah, this was good stuff. And for others of you, your head may be spinning. What I'd love for you to do on whatever platform you're streaming this on, go to my website at americasfavoriteea.com and go to the Contact Us page. If you have any questions at all, I would love for you to send them to me because check this out. My goal is not to get to 1,000 episodes and talk over people's heads. They don't understand what I mean. This whole podcast is to help fill the tax literacy gap. So I've failed my job if at the end of this episode, you don't understand a single thing that I've said, right? Because of course, back taxes shouldn't ruin your life, but not understanding taxes at all shouldn't give you a migraine and ruin your life. All right. So make sure if you have any questions at all, you reach out on the Contact Us page, and make sure that you are also subscribed and following the podcast on all social media platforms and your favorite podcasting platform. I'd like to thank you for taking the time to listen today. I'd like to thank Jim Ray Consulting Services for helping me get this message out to you. I hope you found the information helpful. Did you know 1 in 50 people have a tax problem? Please share this episode with your friends and family because you never know who may need help. Again, thanks for listening. Hey, just as a reminder, this podcast is for informational and educational purposes only. It provides a framework and possible solutions for solving your tax problems, but it is not legally binding. Please consult your tax professional regarding your specific tax situation.